Hey guys, this is Vernon Corum. I'm the short-term pro here, and today I've got Ryan Bakke with me. He's a CPA, and I follow his stuff on social media and Facebook, and I see he's out kind of everywhere doing his thing. And I just wanted to come to you today and talk to you a little bit, Ryan, about kind of what you do and kind of how you do the things that you do. I work a lot with investors here in my local market in the Smoky Mountain area in East Tennessee. And really today, I just wanted to kind of go over some things with you and kind of pick your brain, because I know that you have a lot of knowledge in this area. And I know that my investors and my clients are always looking to get information. I don't want you to give any trade secrets, but, I'd like for you to just kind of go over things with us today. Let's start, Ryan, by you telling us a little bit more about yourself and a little bit about where you come from and your expertise, that sort of thing.
Sure. So I have an accounting and finance degree. That's what I went to school for. And in college, I sought after working at a big company, maybe potentially scaling the corporate ladder, becoming CEO or a partner at an accounting firm one day. And I got that dream job right out of college. I was working at Deloitte Consulting, which is a big four consulting firm. And I was working for investment management, banks, hedge funds, and real estate syndications. And it was very shortly in, I realized that I was helping people who were already rich and wealthy become even more rich and wealthy. And I decided that I not help the everyday person, but I wanted to help the person, their family, that was going to change their family tree. And that's why I started posting content, and I eventually started my own firm, helping solely real estate investors with taxes and analyzing deals and profitability metrics. And so that's what I do still to this day. So I have just regular, tax preparation CPA firm that only takes on clients that are in either my education program or their one-on-one consulting clients. So I have a mix of just regular CPA services. I do group coaching style format, and then I also do one-on-one exclusive consulting, helping people build wealth through using real estate. We work with a lot of, maybe they used to be business owners, they sold their business, and now they're getting into real estate full time. I still work with plenty of people who are both active W-2 incomes, trying to replace one spouse's income with short-term rentals. And I've kind of seen that sort of transition period for all my clients. I've helped people go from both working W-2 jobs to both being full-time in real estate. And I've really seen it all after working with over 200 people in this space.
Right. So do you have investments of your own, like real estate properties of your own? I think I read that somewhere. Tell us a little bit about what you've done.
Yeah, I mean, it all started with the first house, which is the one that I'm living in right now, which was a owner-occupied FHA loan duplex. I lived in the bottom, rented out the top, and I was able to acquire that property knowing the due diligence and knowing about seller credits, and if I can get a property under contract for less than it appraises for, I can bump up the purchase price, and the bank is happy with it, the seller's happy with it, and I'm happy with it because I have to pay less on closing costs. So I was able to buy my first property with little to no money down. And at the time, my mortgage payment was only $1,500 a month, and the tenant in the top was paying $1,200. Wow. So I bought this house when I was 21, actually, and I was able to cut my largest expense ever, largest monthly expense for most people, which is their housing, to only $300 a month. I still have friends that are paying $1,300, $1,400 a month, and they're renting. They're not even building equity. So that's how I got started, first house hack. And that's how I recommend a lot of people to get started if they're young and in real estate. And then it snowballed into another multifamily house, a couple of short-term rentals. And I have one in Ohio on the lake, and I also have one in Miami. And then now I have campgrounds and RV parks too. So pretty successful campground in Black Hawk, Colorado. And then we have one that we're building in Branson, Missouri right now.
Great. So have you seen a change in the market? I know we've seen a little bit here locally in our market in the Smokies. Have you seen a change in the market overall? I know you work with clients kind of all over the United States and things. So what are you seeing as trends in the market right now?
Yeah, the big common concern with a lot of people is, and I sent out an email about this last week, and if you're not subscribed to the newsletter, it's just learnlikeCPA.com, go to my newsletter, but it's return on hassle. That is the most important investor metric, in my opinion. A lot of people get caught up with, cash on equity return or cash on cash return. But what is your time worth? If you're making, let's say you buy a property and you're making net $20,000 a year of income, but it's taking you 200, 300 years to run that, or 300 hours a year to run that property. What is your time worth, and could it be better spent somewhere else? And that's really what we're seeing right now in the market, because when you used to be able to get 20, 25% cash on cash returns for short-term rentals, that's being compressed into, let's say 13, 14, maybe 15% if you have a good deal right now. And is that 15% better than the 8% that you could get in the stock market and not do anything, right? Or the 5% that people can get in CDs right now? And so for a lot of high earners, that conversation is, then it kind of kicks it back to what are the actual tax benefits of the deal. But really, I'm helping people, more importantly, audit their time, their return on hassle.
Okay. Yeah.
And I just think in the market, that's really what is super important right now is that time. So
sure. Yeah. Everybody, whenever you see something on Facebook post about it, when you hear about property management, the first thing people say is, oh, manage it yourself. It's so simple. It's so easy. But you and I know that that's not the case. And when a new investor is getting into this market, and they're coming into this market, they don't really know a lot. They've not done their due diligence. They've not spent the extra time. I mean, I think you will agree that this is a business. This is not just it's not just something where you can just jump in with 2 feet in the water and kind of learn as you go. I mean, there's a lot of people that do it. There's a lot of trial and error in that. So as a young investor or a new investor or someone has a little bit of disposable income that wants to come to you, what would be the first thing you would tell them to be thinking about in the due diligence process? Because I know a lot of people are buying property sight unseen. They're not doing inspections. They're not doing that sort of thing. We all know that's a no-no, but in your case, from your perspective, sometimes by the time they get to you, there could be a mess. So what would be the first thing they should probably be thinking about from a CPA standpoint? What would you recommend they do?
From an investor standpoint,
yes,
run the deal as if you were to hire a property manager anyway. So if you're budgeting 27%, 30% expenses per month, go and add in an extra 10 or 15% and really stress test your deal, because a lot of people are running these deals as they're going to be the one managing it. And I don't manage any of my own properties, just FYI. But I always factor in, I will always tell people to factor in a management fee, even if you're planning on running it, because a year goes on and you realize that, oh, I only made $15,000 managing this property when I make $250,000 at my day job, and I don't need another job. That would be my number one, important tip before even buying a property.
Great. That's good information. Yeah, I think a lot of times people think, well, from the management side, you got to have your boots on the ground, have all that in place. When I would reach out to you as let's say I'm a little bit more established investor, and I've got a little bit of things going on around me. Can you explain a little bit about cost segregation and kind of break that down for people that don't understand that concept? I'm wanting to learn more about it. Person in industry. Can you explain that just a little bit?
Yeah, when you buy a rental property, you essentially recoup your purchase price over time. So let's say I bought a $390,000 property. Well, normally because short-term rentals depreciate over 39 years, I get $10,000 of depreciation expense per year. And depreciation is kind of this phantom expense. It doesn't show up on our profit and loss. It's not something that comes out of our bank account, but the IRS is giving us a dollar figure for the building structure losing value over time, depreciating over time. We know real estate goes up in value over time typically, but the building structure loses value, right? The furniture, all the stuff inside of it's going to lose value over time. And so normal depreciation is taking that 390,000, dividing it by 39 and giving you 10 grand a year in expenses that you can use. So if that property makes $40,000 a year in income, and I have $10,000 of depreciation, well, now I only have to pay taxes on $30,000 of income. And all that cost segregation study does is pretty much speed up the depreciation for you. So instead of taking $10,000 a year for 39 years, you're typically able to get 20 to 25% of that building value in the first year. So in the first year, instead now, I might get $80,000 in the first year, and then maybe it's probably $6,000 or $7,000 for every single year for the rest 38. But it's accelerating those deductions now rather than taking them later. And it's simply a time value money concept. So they teach us that in finance, is that a dollar today, invested into the future is way better than having that dollar, a singular dollar in the future. And so time value of money says if I can get those deductions now, reinvest that money, I can build more wealth with that. And that's the big concept that I teach people is if you really want to get super wealthy, you have to understand how to use debt, taxes, and inflation, because those are the three tools that are going to really help you build wealth. Because number one, I can use debt to acquire properties. I can use leverage. Number two, I get tax benefits on those properties, regardless if I put 0 or 100% down, I still get the same tax benefit. And number three, inflation, I'm able to secure, hopefully during good rate environments, I'm able to secure, let's say, a 4 or 5% interest rate on a lot of these properties that I bought. But inflation is running 7-8% a year, which is, at least that's what they're telling us. And so the money that I'm actually paying back on that loan over time is losing value, because if you owe me $10,000, I want that back as soon as possible. I don't want to I don't want you waiting to pay me back, right? And so understanding debt, taxes, and inflation, if you can nail those three and take advantage of them, you'll become extremely wealthy.
Oh, wow. That's good. There's a lot of common misconceptions too with people when they get into this industry. I've talked to several of my clients, but they didn't go to their CPA when they first got started. And so, they didn't talk to their tax attorney or their accountant. And, they think that there's certain write-offs that are available to them. I mean, you tell me maybe some standard write-offs, some standard deductions, some things that are acceptable, and maybe some things that people think that are acceptable that maybe aren't acceptable.
Yeah. So the biggest misconception is a lot of people think that your down payment that you put down on a house is just deducted. So if I have $100,000 down payment on a $500,000 cabin, well, I'm going to be able to write off $100,000. It doesn't work exactly that way, right? So your down payment, you haven't lost that. It's equity. Sure, some of it's gone to closing costs, which closing costs are deductible to a certain extent. There's some closing costs that are deductible. There's some costs that you have to amortize over the life of the loan. But your down payment is not a deduction, but it goes towards your building value, which is eventually depreciated, right? So one of the good ways that, if you want to think about it, getting your actual down payment money back is to do a cost segregation study, because now you'll have tax savings and it essentially replaces your down payment money. And that's another big sort of wealth transfer idea, because if you have $100,000 and you put it in a property, it's not that your net worth has not changed at all. I mean, it might have been plus or minus, depending on, you might have got an under market deal or whatever, but your net worth is not changing at all. It's just your balance sheet is changing. You have an asset that's you have an asset that's a building now, and you have a liability that's a loan, and now your equity is basically your cash. So it's very interesting to think about.
Yeah, absolutely. Yeah, I think a lot of people have a lot of misconceptions around that. So, as they move forward and maybe they bought a property and they're getting ready to maybe another one, can you briefly talk about the 1031 exchange and kind of explain that process to us and kind of how that works?
Yeah, 1031 exchange has been a really powerful tool for investors for decades now. And the easiest way to think about it is everybody's played Monopoly before, I hope. And it's right when you trade those 4 green houses for the big red hotel. Because if you have a property that has gone up in value and it's been a rental property, you can trade it for another investment property. So if I bought a property for, let's say, $500K and now it's worth $1 million, well, I can go buy another $1 million property and essentially replace those two. But you have to follow strict guidelines, which means you have to hire qualified professionals to help you through the process. And there's also some timelines and delays that are with that. So, for example, when you sell the first property, you have 45 days to identify up to 3 different replacement properties. And you have to list those properties' addresses out as well. And from the day that you sell it, you have 180 days to actually close on one of those 3 properties. And so here's the catch if you're trying to do 1031 right now. Well, you could identify your 3 properties in 45 days, but it might be 5 or 6 months before you know if you actually close on those properties. And if we're going into next year, 6 months from now puts us in February, and you don't close on that property, there's no way you're able to offset your 2023 capital gains tax bill right now. Versus what I would recommend people that are looking to do 1031 right now is is if you sell the property January 1st or January 2nd, you go through the 1031 process, let's say it fails, you have the rest of the year to be able to essentially do what I call a poor man's 1031 exchange, which is where you just buy another property and cost segregate that new property and use it to offset the gain from the sale of the old property. And with that strategy also, the timing becomes super important. And I want everybody to understand this, but realtors, investors need to understand timing. Because if I sell a property on December 15th, the tax bill is due on April 15th of the following year, right? I have 3 months to pay it, 4 months. But if I kick that off until January 2nd or January 3rd, I kick the tax bill back an entire 16 months. Wow. So the timing of when you do events is critically important with tax, especially when you have years where, maybe one spouse loses their job or you get married and you have what I call a shock in income. There's all these different tax planning opportunities whenever your income either goes up a lot and you want to not pay Uncle Sam, or even when it goes down a lot and you're, let's say one spouse loses their job or you have a kid, so one spouse isn't working. So those are like major tax planning opportunities because your bracket is just artificially higher or lower than what it normally is.
Right. Good. That's good information. So, if I'm going to transfer wealth and I want to transfer this wealth to my kids and that sort of thing, I know early on in the process, it would behoove me to know going into how should I structure it? Because becomes a business for most people. They don't understand that, this is not just you written out a lot of time in long term. It's, you could be a landlord and live in a duplex and rent it out to someone next door. But, if you start really wanting to build out a portfolio and you really want to and create some generational wealth and transfer that wealth to your kids down the road. I mean, I know someone would come to you. Give me some different business structures that you recommend from someone just getting started out, but maybe they have a long-term plan to pass it on to their kids or their grandkids or that sort of thing. Tell us a little bit more about what's important to be asking you as a CPA in that conversation.
Yeah, I mean, with any business structure, you have to put in the work. It's very similar to people that want to do bookkeeping, their own bookkeeping. If you just pay for QuickBooks and you don't go in there and actually do it, nothing's going to get done. It's very similar with business structure. So just remember that the more intense that your entity structure gets and the type of entity structure that you have, the more complex it gets, the more in fees that you're going to pay, right? Because now you have all these other entities and you have all these state filings and these tax returns to file that you otherwise wouldn't. And you also have to do a lot of other administrative tasks. So just remember that if you're not ready for that, if you're somebody that doesn't have the ABCs of investing, that, if you can't even scrape together a profit and loss for your property, probably not the best idea to go into a complex entity structure. But what I will tell you that does work is a very simple approach of having a layered LLC approach. So at the very holding company level, you're going to have an entity that, let's just assume it's a husband and wife partnership. You're going to have an entity at the very top of the level that's going to be your holding company. And the sole responsibility of that is to own the LLCs in the states that you have properties in. So I might set up my holding company in a very investor-friendly anonymous state like Wyoming, but all the LLCs that I own, let's say I own a property in Florida, Tennessee, Texas, that multi-member LLC is going to be the single member in each one of my lower level LLCs. And there's all this talk about, hey, should each property be in its own LLC? Should you only have one LLC? Well, you want to have an LLC per state, per property, per state. So if you had let's say you had two properties in Florida, you don't necessarily need to put each one of those in its own LLC, but you definitely need a Florida LLC. If you have a property in a state, you want the LLC to be in that state. As far as how much property in one LLC, I actually have a risk tolerance to this. So my personal philosophy is if I have over $250,000 of equity in any LLC, and what I mean by equity, it's just fair market value minus the outstanding loan balance. Anytime I have more than $250,000 of equity in one LLC, I look to get that out of an LLC. But that's just my personal preference. It could be very different for other people. It depends on the state. But let's go back to the basics. If you're not ready to, hey, each LLC needs to have a separate bank account. Each LLC needs to keep separate books and records. You might have to file additional tax returns. If you're not ready to go through that, you're not ready for a complex entity structure. And unfortunately, a lot of short-term rental investors aren't ready for that just from an administrative burden.
Sure. Yeah, and I find that a lot. People are always asking all the tough questions up front, but I think you got to crawl before you walk. And I think that
Right.
having a guy like you with your knowledge and your experience and your expertise, I mean, just the liability and the risk factors that go into it. Can you explain a little bit more about kind of like, why it's important though to get a structure in place, even the simplest structure in place? Why that's super important. I know in the due diligence phase, a lot of people don't realize how many risks involved with owning investment properties, and so setting it up initially with the smallest version of an entity or the smallest uh, you know entity that's available to them, to prevent the risk and prevent the liability. What would you recommend just as a short-term investor who's just getting started? Where would be a good place to start?
I mean, a good place to start is when you go to write your contracts up, it should be your first name and or a sign. I believe that's the terminology that you put in the
Right.
contract, because
Sure.
that allows you the ability to actually take on the deal with an entity that you do get set up. So
Mhm.
if I'm an investor in Illinois, like if I live in Illinois and I'm trying to buy a property in Florida, but I don't have a Florida LLC set up yet because I don't have a property, I'm gonna write that contract my first name and or assigned, right? And so then that way, eventually, I can form that LLC in Florida and close on that property in Florida. Um, I don't mean to throw the question off, but I have tons of informational material about people who are just getting started with entity structure.
Sure.
You can check it out on my podcast, Learn Like a CPA show, and it's just way more intensive than what I
Good.
could probably
Absolutely.
blurb in 30 seconds.
Sure. And that's why we're here today, is to kind of promote you and promote your business. I looked online, and I saw your bio, and it talks a little bit about, your fitness junkie, you travel, and you do lots of other things. Let's kind of shift gears a little bit. I want to talk to you a little bit about more of a holistic approach of life. What's your purpose behind what you do? Because I know you do a lot of work with a lot of folks, but tell me your why behind what you do and that sort of thing, because we can get all the information in the world, but the things that people are always looking for is, who is Ryan, and what's Ryan based on, and tell me a little bit more about that side of you, because that's the stuff that I'm really interested in today.
Yeah, what I realized that I have a gift of doing is taking ideas and concepts that are extremely complex and boiling them down to something that everyone can understand. And people don't buy what you do, they buy why you do it. And they want to stand behind your
Mm-hmm.
purpose. And my purpose is to help educate and really inspire as many people as possible in become financially free through real estate. It doesn't have to be just real estate, but mostly importantly through real estate. My dream job was to actually be a motivational speaker. The CPA route was just a backup plan. But it's crazy because I find that I get to be a motivational speaker in the work that I do now with my subject matter expertise. So it's just my philosophy is that I think God gives everybody certain talents and abilities, and the first thing you want to do is figure out what you're top 10% at in the world. And so for me, that was probably just overall just math and arithmetic, and it's using those gifts and abilities to bless other people. And when you bless other people, you get compensated in the form of economic status, maybe it's money, but it's also more opportunities to bless other people. So as I started making money and money started coming in, and I could pour back into my people, pour back into social media, my reach got wider, and I was able to help more and more people. And so then it's just this continuous cycle of using your gifts and abilities to bless other people, and then you're going to get blessed in return, and then you just keep repeating that wheel and cycle. And that's really what I do. Well, that's what I started to do with my my business, my content, and just how I touch people every day.
Mm-hmm. Yeah, I believe that's one thing that I really believe in is supporting your local nonprofits or other as a man in your lifestyle every day. How do you balance your work and life with what you have to do? Because I know a lot of what you do probably takes a tremendous amount of your time, but how do you balance that in your life and work in your fitness and get the holistic approach to your life? How do you work all that in? What does your typical day look like?
Yeah, you have to be extremely intentional. There's no doubt about it. If you continue to push things off, if you say, "Oh, I'll do it later," they're not going to get done. You have to be extremely intentional in what you do. And so, one of those things that I do, and I kind of been slacking on, is I try to go to the gym every single day. and I try to eat healthy for the most part because that's important to diet and lifestyle. There's no wealth without health, I believe, and I would say as a technical use a calendar scheduling app. Calendly is an app that a lot of people use. I love it. I don't have any really unscheduled meetings or unscheduled phone calls because did you know that it takes on average 17 minutes to refocus after you've been distracted from something? It takes on average 17 minutes. So I quite frankly don't have that time. And so something like a calendar app where I'm able to schedule out, I don't have to go back and forth with somebody about when they're available. Having something just like a calendar app is the first step, I think, to increasing productivity. It's also finding what I talk about is what's called your genius zone. So your genius zone is, and this doesn't have to be whatever your highest and best use is in regards to your time. It could be your genius zone could be spending time with your family, friends, etc. But the genius zone is what can only you do. What can you only do, right? Like what is your best use of your time? So again, I said mine was taking things that are extremely complex and boiling them down to something that everybody can understand. And so how do you get out of doing all the other tasks that are taking away from that genius zone? And when I first did this exercise a few years ago, I found that I was actually only spending, and the author of this book, he argued that people only spend 10% of the time in their genius zone and 90% of the time doing everything else. And if you can really flip that script to where you're spending 50%, 60%, up to 80% of time only doing the things that you can do in your genius zone, you're going to be rewarded because you're going to be doing the work that you love to do, helping the people that you want to help, and more importantly, you're going to be making more money than you would doing those other tasks that you can outsource or hire out.
Mm-hmm. That's good. That's good advice. So if we wrap up what we're talking about today, do you have any nuggets that you would give to anybody that just wants to get started in this and just kind of get going? And, there's a lot of folks that I deal with as a realtor and as a property manager that just really don't know where to get started. What advice would you give them today? Just kind of give them a little golden nugget of your experience.
Yeah, don't fall into analysis paralysis. There's the saying that a lot of people have analysis paralysis. There's also the saying, hey, if I had 12 hours to cut down a tree, I would spend the first 10 sharpening my axe. Well, I think that we have to know when is it time to sharpen the axe and when is it time to cut down the tree because we only got 2 hours left of daylight, right? Mm-hmm. So knowing when to take action on an opportunity versus knowing when, okay, I think I need some more help here, or I think I need to sharpen that axe a little bit more. That's the most important thing people can do when they get started is know when to jump on opportunity and know when you should, do your due diligence, vet it a little bit more and wait for that opportunity to come. But don't spend so much time sharpening your axe that you run out of daylight.
Mm-hmm. Great. Well, Ryan, I really appreciate your time today. I know you're a busy guy and I know you got a lot going on, and I appreciate you coming in here to talk to me today. So tell us a little bit more about where we can find you. I know you mentioned it throughout the podcast, but we'll actually put this in the notes as well. But give us the where we can find you. I really want to learn more about your podcast for sure.
Yeah, so you can find me at all social media platforms at Learn Like a CPA, and I have a Facebook group called Tax Strategies for Real Estate Investors. We've got about 7,100 people in the Facebook group posting content daily in there as well. And then the podcast is also Learn Like a CPA show on all social media, on all podcast platforms. We're on Spotify, Apple Music, Amazon Music, all podcast platforms. So.
Good. That's great. Thanks. Well, Ryan, is there any parting words you'd like to give anybody today as we exit out of this interview today? Anything that you'd like to share as we finally close this podcast out?
Find a mentor too. I think having a mentor, somebody that's done it before, is extremely important. They can just save you so much time and money and effort if they have already been there. And you can also be a mentor too. People who are once broken can fix broken people. People who are once overweight can help people get in shape. And people who, and that's why the first step of Alcoholics Anonymous is you need to find somebody that's already gone through the program. So find a mentor.
Right. Well, that's good advice. And so, as I have folks, I'm going to send them your way that have things, they have questions about being, in the CPA side and the accounting side. So Ryan, again, I appreciate your time today, and I really would love to pick your brain some more down the road, and maybe we can meet up at one of these events. I see that all the time. So, again, thank you so much for your time today.
Yeah, you're welcome.
Reach out to Ryan today. Make sure you go check him out. Check out his podcast. Get on that Facebook group, because I think that is a super important part of this. Is I understand the service side and the real estate side of this, but I always have to go seek out professionals like yourself, and I know just enough to get me in trouble. So I always love to come to people that know what they're talking about, and that's why you're on my podcast today and just talking to us. And so, guys, if you want to find out more about me, obviously I'm Short Term Pro at all over social media, also shorttermpro.com. But anyway, guys, go check out Ryan's stuff and give him a shout out online when we put this episode out, and just kind of, get connected. This guy really knows his stuff, and I really thank you for your time today, Ryan.
Awesome, guys.
Thanks.